In this video, I'm going to explain why Michael Saylor is probably a financial engineering genius, why his newest product is his most brilliant one yet. It could change absolutely everything for Bitcoin, and why about 2 days ago, Saylor himself convinced me not to buy it. If you don't know by now, I'm talking about Strategy's latest preferred stock offering called Stretch, SRTC. Love him or hate him, you have to admit at this point that Saylor is basically putting on a financial engineering masterclass. He spent the last 6 years coming up with novel ways to create financial products built on Bitcoin and create on-ramps for enormous pools of capital to access Bitcoin exposure, even when they're not willing or able to buy actual Bitcoin. And Stretch is probably the most brilliant one yet.
We're taking a common thing, a publicly listed company, a public security, a capital asset, digital capital asset in this case, a preferred security, the idea of a monthly dividend that's variable, and a tax treatment, return of capital that's been around since 1910, and then an ATM actively managed. And you put together all of these components, no one of them is all that difficult. You put all of them together and you create something which is much more than the sum of its parts. You've created an extraordinary breakthrough in the entire world of credit. We call it Stretch, STRC.
I'm not the first person to make a video about this, not even close. I've seen many people already calling it Bitcoin's iPhone moment. Essentially, I assume what they mean by that is this could be the thing that takes Bitcoin mainstream. Because even today, most capital in the world still can't or won't buy Bitcoin directly. But Stretch is designed to make Bitcoin accessible to the largest pool of capital in the world, which is fixed income investors. It's a yield product that can be held in bond portfolios and is backed by Bitcoin, but theoretically shields the holder from the volatility of holding Bitcoin itself. So Saylor is attempting to use financial engineering to have his cake and eat it too. He gets to buy more Bitcoin and accrue that Bitcoin for MSTR equity holders. And you, as a Stretch buyer, get an extremely attractive yield product designed to trade at a stable price and pay large monthly dividends. So Saylor strips out the volatility, keeps the upside appreciation for himself and the MSTR equity holders, and the Stretch holders give up the exposure to Bitcoin's upside in exchange for low volatility and high yield. Many of you are probably already familiar with Stretch. I'm purposely not going to go all the way into the weeds of every detail of how it works in this particular video. But if you're not familiar, I will explain it very quickly. Stretch is essentially a Bitcoin-backed yield product. It's an equity offering that you can buy just like any other stock, and it's structured to always trade right around $100 per share par value. And it pays about an 11% yield. Actually, they just raised it to 11.5%, which in today's market is extremely attractive for fixed income investors. For context, 10-year US Treasury bonds currently pay a little over 4%. And those bad boys, I'm told, are risk-free. Well, if you believe in two key assumptions, then you might believe that Stretch is risk-free too. Those assumptions are: one, there will always be demand for yield, and two, Bitcoin appreciates over time. If you believe those two things, then this is basically how it all works. Stretch is designed to trade around $100 per share. If it trades above 100, Strategy can create new shares and sell them into the market. The issuance of those new shares soaks up demand until the price falls back down to $100. Strategy gets to take that money, those proceeds from issuing new shares, and use it to buy Bitcoin. If Stretch trades below $100 a share, Strategy simply stops issuing new shares. The yield becomes even more attractive because it's paid on the $100 par value, not necessarily the price you pay for your share of Stretch. So if Stretch drops to $99 or $98, the effective yield for those buyers becomes even higher, which obviously increases the demand, and more buyers step in until it gets bid back up to $100. So it sounds pretty simple. If people keep wanting yield and Bitcoin continues to appreciate over time, it just keeps chugging along. And so far, it's working. It has only been around for less than a year, and for brief periods, it has traded down as low as $92 or $93, but it's always recovered. There's a website and a Twitter account that popped up recently to track Stretch's trading volume that occurs above that $100 threshold. And lately, it looks super bullish. I don't believe this website is based on official data, and so they're making some assumptions about Strategy actually issuing new shares every time Stretch trades slightly above $100, and they're making assumptions about how much Bitcoin Strategy buys with the proceeds. But recently, we're seeing days where 97% of the volume trades above the $100 threshold. And based on assumptions you can make about the math, Strategy could be issuing enough Stretch to buy 1,000 Bitcoin in a single day. Again, take that with a grain of salt because we don't know if that's exactly what happened. But the point is that it's proving the concept. It's demonstrating real demand for the product. And a key point is that this is demand coming from people who may never own a single Satoshi. Right now, like I already said, the vast majority of capital in the world still either can't buy Bitcoin or doesn't want to buy it directly. The largest pool of capital in the world is not stocks, it's fixed income. That's pension funds, insurance companies, bond funds, endowments, wealth managers, corporate treasuries, hundreds of trillions of dollars, most of which literally cannot buy Bitcoin directly because their mandates don't even allow it. So they need something that looks like a bond or a credit instrument. And that's exactly what Stretch is designed to be. It turns Bitcoin into something fixed income investors can actually buy. It's the latest iteration in what Saylor has been building all this time. Basically, a multi-layered Bitcoin accumulation machine. He's offering multiple different security products, each one designed for a different investor profile, but they essentially all do the same thing. They convert traditional capital into Bitcoin accumulation.
Our company is converting capital into credit. We're converting economic wealth into a stream of cash flows. That is the big breakthrough. You need an operating company in order to take a block of economic energy and turn it into a currency, peg it to a currency, strip away the risk, damp the volatility, extract the cash flows in the form of yield, and compress the duration to now.
We can very well assume that people buying Stretch are not even people who care about Bitcoin. They just want the yield. What that means is this is potentially a whole new category of demand funneling money into Bitcoin. And if this model works, it could change Bitcoin's demand structure entirely. Because we are used to demand appearing in cycles, spiking when sentiment is bullish, crashing when things turn bearish. But Stretch represents something different. It's just continuous Bitcoin accumulation, week after week, regardless of sentiment, funded by investors who want yield in dollars but don't even care about owning actual Bitcoin. Needless to say, there is no guarantee of how this will all play out long term, but at first glance, it is an ingenious feat of financial engineering. The most bullish version of this is that Saylor may have essentially built a permanent demand machine that pumps fiat out of traditional finance from institutional investors straight into Bitcoin. If that's all true, it could change Bitcoin forever. And even if it's all true, I'm personally still not buying Stretch. And I'm not just saying that because I don't want the yield. I'm saying that because Saylor himself gave a fantastic keynote presentation the other day at Strategy World 2026, where he laid out this whole digital credit thesis. If you have questions about anything I've said so far, I suggest you go watch that full video. But he said one particular thing that was the key that made me want to make this video, and I'll play it for you right now.
People don't want to get rich suddenly in the distant future, unexpectedly after a roller coaster ride. What they want is to get rich steadily with very, very low volatility, no anxiety. They don't want the fighter jet. They want the jumbo jet airliner, and they want to recline in first class while they go to their destination.
Most investors hate volatility. Obviously, if you're anywhere near Bitcoin, you see that commentary all the time. Hey guys, Bitcoin is the best performing asset in human history. Oh, but it's way too volatile. Most people just want steady income, predictable returns, and low stress. And obviously, there's nothing wrong with that. Stretch is designed to cater perfectly to those investors. It's designed to succeed precisely because people are risk averse and volatility averse. Maybe I'm wrong about this, but I assume you have to still believe to some degree in Bitcoin in order to want to buy Stretch. Because if you really thought Bitcoin was going to zero, you're definitely not going to buy Stretch. So you have to believe at least Bitcoin is going to appreciate at a rate greater than the yield they're offering. Otherwise, the math just doesn't work. So the existence of demand for Stretch literally tells you there are people who believe in the Bitcoin thesis, but are so afraid of the volatility, they're willing to give away the asymmetric upside in exchange for a little less stress along the way. In my humble opinion, Bitcoin is not designed for that mindset. Saylor can engineer a product that caters to those people. That's totally fine. But Bitcoin itself rewards something totally different. It rewards conviction. If you ever watched this channel, you probably heard me say it before. Bitcoin is about growing a pair. Bitcoin is one of the most asymmetric opportunities in financial history. But most of the world still doesn't understand it at all. And that information gap is where the opportunity comes from. If you study Bitcoin and you understand the fundamentals, you understand what the real opportunity is. And you don't see the volatility as a risk. You see the volatility itself as the opportunity. Watch this video I made the other day if you really want to understand why the supposed risk is the opportunity. In short, Bitcoin is the best asymmetric bet there is. But in all this talk about digital credit and investments and returns and yield percentages, there's one little detail that seems to get forgotten. Bitcoin is not just another investment. It's the first and only digital, global, peer-to-peer, permissionless, censorship-resistant monetary system in the world. It exists outside government control. It takes power away from the central banking cartel and provides an escape from the evils of the inflationary fiat clown world. It's freedom money for 8 billion people that also just so happens to appreciate in purchasing power forever. So you can have all that, or you can have 11% yield. So yes, Stretch is brilliant. It might unlock trillions in fixed income capital. It might create a permanent bid for Bitcoin from traditional finance institutions. And if it does, that sounds great. But personally, I'm not here for the yield. You do you, but my plan is to quit slacking and start stacking.